you, Aditya, and it's my sheer pleasure and privilege to be here with this August panel here today. First of all, I'd just like to sort of check, am I audible properly to everybody?
Yes.
Yes,
okay.
you're audible.
Yes.
Thank you. Hello and a very warm welcome to everybody. I am Shraddha Agrawal and you are watching the 8th edition of the annual India Alternative Investment Summit. I would like to thank the organizers, AIWM and Aditya, for putting this together. We have a pretty meaningful panel today, but before that, let's do some context setting. The topic for today's discussion is a pretty straightforward one. The role of AIFs in making India a $5 trillion economy. When we are talking about growing India's economy to a $5 trillion economy, what really are we talking about? We are talking about financing countries' huge infrastructure requirement, which stand at $1.5 trillion today. We are talking about long-term annuity-seeking investments here. When we're talking about growing India's economy to a $5 trillion economy, we're talking about long-term investments in building up the MSME sector, where startups and early-stage businesses contribute to jobs and value creation. When we're talking about India's economy to a $5 trillion economy, we're talking about developing the entrepreneurial ecosystem in the country. And when we're talking about growing India's economy to a $5 trillion economy, we're talking about massive capital infusion across several segments: healthcare, infrastructure, affordable housing, manufacturing, logistics, IT, financial inclusion, banking, financial services, insurance, consumer product services, education, etc. All of this means that it is locked in sophisticated capital and it cannot be met by hot money, which is subject to the vagaries of FIIs, institutional investors, and stock markets. Given there are various constraints faced by the traditional lending ecosystem in the last decade, the role of alternative capital in supporting India's economic growth aspirations and reducing the strain on government finances has been immense. Just to give you some data and some pointers here, Indian market received an all-time record of $48 billion of private investment in 2019 and roughly a similar amount in 2020. Aggregate private capital investment in 2009-20 period reached $250 billion. Alternative investment funds, an innovative product which mobilizes investments in real estate, private equity, land, venture capital, intellectual property, and equity long-short strategies are all alternative investments, have really been at the heart of it. The Aif industry in India has been evolving at a rapid pace and invested over 1.8 lakh crore across ventures at the December 31, 2020. India being a high-performance market with a stable GDP will see a quantum increase in capital flow into the capital markets, and AIFs are no exception. Alternative investments have grown rapidly in the past 3 years on account of proactive regulatory reforms such as foreign investments in AIFs and the automatic route, tax pass-through structure implemented for Category 1 and 2 funds, and permission to invest in commodity derivatives, etc. In my next 45 minutes that I have with this August panel, my endeavor here will be to really understand what role have AIFs played in mobilizing India's economy to a $5 trillion economy when we start by the year 2025. This is the inaugural session. Please help me welcome Andrew Holland, CEO, Aif Capital Public Market Strategies; Manoj Shenoy, Chief Executive Officer, IFL Asset Management; Anjali Bansal, Founder, Wana Capital; Sunil Singhania, Founder, Bacchus Asset Manager. Gentlemen and ladies, it's my sheer pleasure and privilege to welcome you all to this. Let me just begin with you, Andrew, in no particular order, just going alphabetically. On this entire moot point of AIFs really being the next cutting edge option for foreign investors, I think the government's intention is pretty clear within the form of AIFs or the gift city or relaxation, the tax laws, and allowing fund managers to operate from India. I mean, the intent is pretty clear, is to create an ecosystem and in some sense replicate or move some of the fund management activities from Hong Kong, Singapore, and other jurisdictions. And AIF is a wonderful product to do that. Can one really say that when you talk about investments and foreign investments in India, perhaps AIF is the future in many ways? What really is your argument in this direction?
I think a lot of the initiatives by the government have been, very encouraging. I mean, Gift City, which you mentioned, does allow funds like ourselves and others to set up shop there. If you go offshore, basically there's a few ways to do that. One is to have someone based offshore, and obviously all your management fees go there. You can try and use 9A, which obviously you can have your, you can have your managers sat in India, but you still have to have an offshore structure. So Gift City brings everything together in one go. So that's the good news. Now, as a jurisdiction, obviously it's going to be new to investors. So I think it'll take a little bit of time for people to adjust to this, and investors to feel comfortable coming to India as an alternative to, say, Singapore or Ireland or Luxembourg or those places. But I think once a number of funds start up and investors can see it's actually very successful, which we expect it will be, because all the tax rules are exactly the same as if you were offshore. So there's nothing there for the foreign investor to worry about. I just think it's that bedding in process which takes a little bit of time. But I suspect that you'll see quite a number of funds over the next 1 month launch from Gift City, which will start that ball rolling about bringing confidence to Gift City, and therefore the regulations that have been put in place around it. So I'm very encouraged by that, and I think it will lead to a lot of funds. Particularly one of the problems I think in India for long short funds is two facts. One, we've been a long only kind of regime anyway in terms of the mutual fund industry. So we've really just started to build the capability, and therefore, trying to build a track record and then go offshore with the kind of high costs that it is to set up offshore. Gift City really kind of helps a lot of fund managers going forward, to kind of raise money offshore as well.
I would like to bring you in, Sunil, here. We just heard from Andrew, and he sort of mentioned that the entire Gift City move will bring confidence to investors, and perhaps is a huge measure to boost the economy here. This entire argument that we're talking really about, that AIFs really to be labeled as a future for sophisticated investing, do you really think that the future in many ways can be labeled AIFs and that really has arrived? What really is the sense that you can give us?
Thanks a lot for giving me this opportunity and sharing my views. So I think, AIF obviously has added to the options available to the investors. It brings in a lot of flexibility. It also allows, portfolio managers like myself to branch out on their own. SEBI also recognizes that AIF is light touch, catered to sophisticated and large mature investors. And I think it definitely adds in a lot of options. At the same time, for any country and economy and the financial market, I think all segments of the financial markets are important. So I would say mutual funds, AIFs, private equity, venture funds, they will all go together in ensuring that we are able to attract the capital which the country needs to grow rapidly in its quest to maybe have a sustainable 7.5–8% GDP. Gift City is also a direction, a step in that direction to ease, managing offshore money by domestic portfolio managers like ourselves. It's early days, but we have seen in other parts of the world, ultimately these kind of initiatives and specific zones are becoming very successful. There is no reason to believe that in India we will not have that. So, within obviously, I represent an AIF company, so my bias will be towards the AIF. But I would say that if you just mentioned all the numbers and like 80,000 crores and all, I think in the last 5–6 years where AIFs have been operational, this is a huge amount of capital which they've been able to attract. And there is no doubt in our, at least, our minds that this corpus is going to double in the next 3 years. So that would be a big achievement given the fact that mutual funds took almost 20 years to reach that kind of size, and then they took off. So it's a good sort of a beginning. And I would say that AIFs have played a vital role and they will continue to play an even important role as we move forward.
Thank you, Sunil, for that. I come to you now, Manoj. Manoj, you heard both your co-participants, Andrew and Sunil. I think huge optimism coming in the way of AIF here. And just to take a segue from what Sunil just mentioned, that mutual funds perhaps took 20 years to reach where AIFs have reached in a very short span of time. So one can really see the momentum and the optimism. I mean, the way you grew IFL, Taran was here prior to you, raised funding from investors like GA, and what the kind of franchise that you all have grown. So you have seen the life cycle coming from mutual fund to investing in all across asset classes to now AIF. Manoj, if I were to ask you a question, and Sunil pointed that out, that he's an independent asset manager. If somebody were to branch out as an independent manager in 2021, wouldn't the natural recourse be to set up an AIF rather than going for a mutual fund? What really is your sense? I would like an honest answer here.
Okay, thank you very much for having me here. And also I would like to wish Sunil a very happy birthday. I heard it's his birthday today.
Thanks a lot.
Sunil, yeah. So, okay, let me step back a little bit. I think we need to look at, see, when we talk about AIF and how it is going to grow, obviously, Sunil said it's going to double and, next 3 years and stuff like that. And I think we are actually underballing the opportunity, number one. Second, I think the second thing what we need to look at is how AIFs operate globally and what is the share of AIFs as a percentage of the managed market funds. So if you take a US example, it is the AIF market is around $11 trillion. It is we are not even scratching the bottom of anything. We are just about $27 billion today. And even if you take Europe, it is close to about, these are last year's figures, these are about $7 trillion again. So if you take as a composition of the managed markets in both these jurisdictions, whether it is US or even in Europe, it is in excess of about 30-35% compared to mutual funds. Mutual funds are about 65% in US and it's 60% in Europe. So that itself, according to me, gives us a big picture in terms of how AIFs can grow in India. And to a large extent, I also agree in terms of whether, fund managers like Sunil moving on and then setting up their own alternates. Yes. See, today, I think, if you want a normal investment, structure, the mutual funds are already there. And it is, anyway, it is growing. It will grow because it's a retail. It's meant for retail. And also, the kind of retail participation is growing. That will certainly grow in any way. But the kind of wealth that is being created today, compared to what it was 10 years back or 15 years back, 20 years back, a whole lot of wealth is being created because of ESOPs, because of people selling out companies and, all those kind of stuff. Now, this set of people are keen and interested in taking a slightly higher risk and a investment stuff where they can customize to their risk appetite and how they want to grow their assets and stuff like that. So given that, my feeling is that a whole lot of the new strategies, if new fund managers bring on the table, there is no reason why these AMCs can do extremely well just doing the AIF and not having a mutual fund. But the mutual fund will certainly continue to be the main stable because that's a way to channelize actually the retail money. And this will be for sophisticated and professional investors.
Thanks for that, Manoj. I would sort of come to you, Anjali, before sort of coming to you and talking about really the entrepreneurial ecosystem and what role it has really played for the AIF. I want to sort of bring in you, Andrew, and Sunil again to sort of just the point which Manoj just mentioned right now that while the mutual fund industry will continue to grow, he does not really see a problem with independent asset managers really going through the AIF route. As somebody who has covered the private markets for more than a decade right now, I have really seen this actually happening in the private equity space also. First came the international PE funds, the Blackstones, the Carlyles, the GAs. And then we actually saw a lot of high-profile fund managers transitioning out of these international PVC firms and setting up their own shops. Some of them have actually become pretty large established shops right now. Also look at the likes of Risk Capital or a Kidara or a True North or a multiples equity partners. So Andrew, my question to you really is that what remains the future of the mutual fund industry then? Will it be a vehicle, the mainstream vehicle, again going forward to mobilize the retail participation, the number one vehicle? And will AIFs constitute a space for a more sophisticated or a more sort of polished HNI audiences? What really is your sense there? Will we see complete demarcation going forward in the financial services stroke asset management industry?
I mean, some of that will depend obviously on regulation, as you're probably all aware that you know, any investment in an alternative investment fund in India, whether it's category 1, 2, or 3, there's a minimum investment of 1 crore. So that does take away a lot of you know, the kind of investors, retail investors to that. And I think SEBI, you know, are wanting to make sure that, and quite rightly so, that the investors coming into the types of products which are sophisticated, you know, either have the wealth or the knowledge to be able to kind of understand the risks that are involved. And I think that's a key element. But, you know, let me put it this way. You know, I have investments in mutual funds, debt and equity, and I have alternative, you know, assets. I don't think that's going to change overnight. I mean, the product might change. People might go for more ETFs and active management, which we're seeing globally. But I think we'll all do our savings on a regular basis through mutual funds, you know, because the threshold to 1 crore is quite high for people starting off on the ladder of investing. So you're not going to put that much into a fund straight away. So I think, you know, the SIPs are always going to be through, you know, through retail and through mutual funds. So it's an industry that's not going to go away. It's going to continue to grow very rapidly, you know, over the next, you know, 10 to 15 years, that's for sure, with many new products coming in. But the alternatives is what it is, right? You put a certain amount of your asset allocation towards alternative assets. Now, it can be private equity, it can be real estate, it can be art, it can be wine, it can be anything it wants to be in that. And obviously the alternative investments that we're talking about do form overseas anywhere up to 20% of people's asset allocation outside of their mutual funds. So that's really how I don't see that it's us versus them. I think there's enough for our industry to grow multifold if you're going to be a $5 trillion economy, and it has to do that. So I think the outlook for both mutual funds and alternatives is very high.
Okay. Anjali, I would like to bring you in. I think you heard from all your co-participants, Sunil, Manoj, and Andrew here on, you know, what really is the future growth path for Aif industry. We also spoke a bit about, you know, how does it compare vis-a-vis the mutual fund industry. And the big takeaway one is really getting is that one is not eating into another, given the fact that even the AIF has surely seen a rapid growth. And while the mutual fund industry took about 20 years to reach where AIF has grown in the past, like 7 to 8 years. Anjali, I would like to bring you in here. I mean, you bring a very interesting perspective to the table, you know, coming from, you know, a very active VC background, really. And I want to sort of, you know, ask you, Anjali, that, you know, when you talk about AIFs, or you see the investor participation into AIFs, what really is the role they're really playing in propping up the entrepreneurial ecosystem? I ask you this also just given the amount of capital available on the sidelines right now. Do you think that just the amount of dry powder that we are seeing in private equity, venture capital, combine that with talent pool of managers like yours, can surely assist in economic recovery of India, and AIF can play a huge role here?
Thank you, Shrija. It's a big question. I do want to add, I also sit on the board of a very large public market asset management company. So I don't think mutual funds are going away anywhere, and they should not. That industry will continue to grow. It will continue to see fund inflows. That industry will also have to innovate. Just as AIFs are an innovation in the private space, the public space will have to innovate with new products, maybe more technology-enabled sachetized products and so on. We are seeing the emergence of players like a Zerodha and a Grow and so on. So there is innovation and disruption happening in that space as well. ETFs, clearly, sort of whether it's actively managed, passively managed, crypto, all of these are new products and asset classes that will emerge. On the AIF side, to me, AIFs actually are a very, very positive development in India. The right policy framework, lots of enabling regulation, and continuing engagement between the regulator, so SEBI, the government, so Ministry of Finance, and industry. So this continuous dialogue, I think, will continue to provide the innovation required also, and the continuing evolution of the AIF regime itself. So Gift City, IFSC, the enabling tax regulations there allows us to onshore what used to be previously offshore. It brings a lot of benefits here, which have been talked about, so I will not go into detail. The biggest advantage, and I think the raison d'etre almost for AIFs, is to allow domestic capital to participate in some of the highest return categories, which is why it is fair that AIF participation be somewhat focused and limited to sophisticated investors. Typically, private investing is long-term illiquid asset class. And yes, of course, we are seeing the emergence of lots of unicorns, but remember, they are not overnight. It takes anywhere between sort of 3 to 10 years to build a really big company out of a startup. But the pace, the energy, the variety, and the excitement of the startup ecosystem should be accessible to Indian investors as well. And not just HNIs and individuals. And I think we are now starting to see some signs and the right policy support for the participation of our large domestic institutions as well. So globally, if you look at alternative assets, the limited partners or investors in those funds tend to be pension funds, endowments, foundations, and so on. In India, this space has not seen the participation of, say, our large insurers. So, the LICs, GICs, EPFO, and so on. So opening this up, I think, will add more capital. It is the AIF regime makes it easier for also entrepreneurship to emerge in the fund management space. You no longer have to think about setting up overseas and they're doing a sort of nudge, wink, wink as to where is your poem and so on. It gives you a very straightforward way to invest in the Indian startup ecosystem, which is where I typically participate, and capture the returns from some of those the startup outcomes that we are seeing now.
Mm-hmm. So I want to sort of bring you in, Sunil, to sort of what Anjali just mentioned. I think if there are two words that I've heard the maximum in the entire pandemic phase is this digital transformation. And rightly so, if you speak to VCs, it's really at the tale of two cities. While some boats are low, some boats are really high. We are seeing unprecedented amount of deal making in the private investment space. I'm talking about startups from Series A to Series B to Series C to Series D. And at the point which Anjali mentioned that, AIFs really have a great gateway in them. It provides domestic investors to also partake some of the upside of investing into startups. So do you think that, in that way, just in terms of product innovation, which AIF brings to the table, you think the other capital market instruments like mutual funds also need to really innovate in that regard? The product assortment for AIF just becomes so much higher and deeper compared to other products that we have right now.
See, we have to understand the whole ecosystem. I've also been in the mutual fund for a long, long time. Most part of my professional life I've spent in the mutual fund industry, and I've seen it grow exponentially right from 2002-03 when I joined, right till 2018 when I left the mutual fund industry to start up my AIF. So mutual fund industry predominantly cater to the retail segment, and obviously it's a high regulation industry, because obviously the regulators are very concerned about the retail investors. When you talk about startups or PE and venture funds, we all like to glorify companies which have become unicorns and which have become 10 billion and 20 billion and 50 billion. But for every one unicorn, there are 100,000 startups which have gone to zero. We don't even talk about it. You don't want a scenario where you offer some exotic products to retail investors who don't understand it. And I think that is the reason why the regulator also is very clear that these are the instruments and these are the investment opportunities which are suitable for so-called accredited investors. The term is prevalent in global markets. It is now slowly being introduced in India also. And there are some investment opportunities which are simple and which are suitable for the retail. So I think that is one thing. The other thing is because of their very nature, and you have like 7 million, 8 million, 10 million investors for mutual fund, they would want to first try and increase the penetration of that segment itself. I think even on the retail side, and I think Andrew pointed out, which was very relevant, that in India, the whole ecosystem has huge potential to grow. We don't even have 4 or 5 crore unique investors. I think that number itself can grow 5-10 times. So the mutual funds are doing the right thing by increasing their penetration and into going into different cities, towns. The regulator is encouraging them by giving incentives for beyond 15 cities and beyond 30 cities. So let the mutual funds concentrate on that. The high net worth individuals, family offices are people who are sort of in inverted commas, knowing what they're doing. They can take some higher risks. So whether it is venture funds or AIF 1, 2, 3 or some other instruments, let them cater to this large family offices. As far as the insurance companies and all are concerned, I think recently the regulator has started to allow them to invest in AIFs, which is a welcome decision. And hopefully, as and when they start to get comfort, that flow will only increase. The last bit I would like to add is that in India, the startup culture and venture investing and high risk investing is new, and the regulations are also not very conducive for any company to raise capital in India. So if you actually see, most of the very successful unicorns in India have structures which are investable by overseas investors by being outside of India. And I think that also will gradually change. So we have a long way to go, but we have come much ahead of where we were in the last 4 or 5 years. And, we have to have patience and we have to be optimistic. I think there will be many, many opportunities across this ecosystem. That is what I can say. You just have to remember one thing.
I can see Anjali smiling to your point where you mentioned that a lot of unicorns are foreign funded. I think that is actually a pity that we are not using local rupee capital to have more homegrown unicorns, just given the kind of local technology pool and talent that we're sitting on. We don't really need a SoftBank and a Tiger Global to come and tell us which is the next unicorn. We should have more AIFs, more insurance companies, more local banks, financial institutions, and HNIs to come and spot those unicorns. And I think,
if I may, I would. It's not either or. We need them all. India needs a lot of capital to really meet our full potential and get to the $5 trillion economy and so on. So I think all capital, if it's the right kind of capital with the right intent, is welcome. So whether it is SoftBank, Tiger, they actually provide that late stage, large check capital that gives that big scaling up boost to a lot of companies. So that is also required, but this is also required. So as India goes through the journey really of financializing of savings, then a lot of those savings at the retail level will move into mutual funds, the SIPs and so on. That's where they should be, instead of sitting sort of idly in bank deposits necessarily. At the same time, for those who are sophisticated, understand the risk, where not every startup becomes a unicorn, right? Very few actually do. And there is value creation, even if it is not a unicorn. So to be able to participate for domestic investors, and absolutely, when whoever participates in the capital of a successful business is who benefits from it, right? You get the returns. So for us to capture the returns in India, the financial returns coming to India in the pockets of both individual and institutional investors is where I think AIF plays a very positive and important role.
Yeah. So I think 2 or 3 key sort of takeaways are becoming very clear here in terms of the investor class bifurcation between the mutual fund industry and the AIF. It's not really one versus the other. And I think the risk profile for both the asset classes are becoming increasingly defined. I want to sort of bring you, Andrew, in here. And, this entire question of, one not sort of eating versus the other, there's a large market and all of us can coexist. So what about this entire disruption factor that one talks about? I think there was a mention of the likes of Zerodha and Upstocks and Grow coming onto the fore. How does the way fintech really came a big part of the lexicon, with neo-banking and open banking really being seen as threat to the large banking industry. And perhaps I would not use the word threat, but perhaps coexisting, where banks are clearly embracing the value of technology that brings to the table. How are big asset managers really seeing the likes of Zerodha or the Upstocks or the Grow coming in to the fore, especially when they're so heavily, hugely funded?
I think it still has some way to go. I mean, I think from the mutual fund industry, as we've seen in developed markets, is that ETF, smart beta, ESG, all of these are going to be products which are going to be off the shelf, low cost. Now it depends on which of the mutual funds want to kind of eat into their own products very quickly. So I'm not an expert on that. Maybe Sunil will have a better idea in terms of the mutual fund industry. But that would be disruption, right? Disruption in terms of ETF, smart beta, and those kind of products, which are will have a very, very small cost to invest, and you're just replicating or beating the index, which everyone is finding hard to do at the moment. So that's obviously technology will play a role in that, not just for managing the product, but for distribution as well. Maybe the old, kind of go through distributors and investment managers might just change because of these products. In terms of my world, quants I think is starting to rise in terms of hedge funds and people's acceptance of quants. And then of course AI will, artificial intelligence at some point will, I'm sure, come to India's shores. But I think we're some way away from all of these at the moment, where investors I think will probably latch on to more of the lower cost type ETF product quicker than maybe a more sophisticated quants model or AI type of model on the Cat3 type of investors. So that will take a bit more time in my view.
Okay, Manoj, I wanted to sort of like to bring you in that, why is that every conversation about AIFs is usually marred with this mumbo jumbo around taxation? We saw some clearance on category 1, category 2, but why is this that category 3 funds, whatever that question brings in, it always is laced with this entire taxation issue? That is number one. And why is it that AIF are always being construed as something just complicated? First understand the risks better and then jump into it, as compared to a mutual fund where there's this entire machinery by the government which tells you mutual fund sahi hai. It's more retail, it's more appealing. Why don't we see a similar level playing field, or would you say perhaps a more level playing investor education, if you will, around AIF? Why does it come in the first blush being something which is okay, complicated, I would get there later?
Okay, so this is one is we need to understand that alternate industry itself is just about evolving in the last 5 years. It all started in 2012, last 5 years. So it looks a little complicated for a layman when you take a product which is differentiated, number one. I think as Anjali said, these are highly illiquid investments in some case. In some case, what Andrew does, he was the pioneer in getting the long short in the country way back in 2013. People didn't understand what it was, but then within the next 2-3 years, people understood that, okay, it's a hedge, it's actually a hedge fund, and then you get a debt plus kind of a return. What you can expect from there, and what you can expect from a venture fund, and what you can expect from a... So I think it's an evolving story. So I don't think we can rush into getting people to understand things and stuff like that quickly. I think to a large extent, I believe what will change all this, including the taxation and the understanding of all this, is just like how it works globally. What is called as a professional investor. So we are today in India, the regulator is already started a discussion paper on how to classify a professional or a qualified investor. So once that category is identified, and a person is identified as a professional or a qualified investor, then the investment, it's understood that this person is qualified to understand what is given to him, and including illiquid stuff, long the gestation in terms of 3 years, 5 years, 8 years, kind of a stuff. All these misgivings will go away. So today it should be sold to whatever product that is being created has to be sold to just the right kind of an investor. If you sell it to an investor who is expecting, just like a mutual fund unit, that he can get an exit in next 6 months, 1 year, obviously, not only is misunderstood, he will always, throughout his life, he will complain saying that, something wrong has happened to him, and some wrong product he has got into, though he would not have understood. So I think the most important thing here is whether it is, yes, a lot of things will have to happen on the taxation side. Again, if you look at the global example, a lot of benefits are given to AIF investors. So probably those things will evolve once the size of the industry also grows, and then there is a representation from the industry also, and things will change. But the most important thing here, I would say, is that things will change drastically in the country once we are able to identify and say that he or she is a qualified investor, and then the regulation reduces for him or her, and then it is easy to sell stuff to them, and all this misunderstandings and misgivings and whatever is happening today will all vanish, and things will be normal, and the people will be able to invest as easy as what they are doing through the mutual fund, because they understand the whole thing.
Sure. Sunil, I would like to sort of bring you in, and then I would sort of bring you, Anjali, in for the solutions. You are an independent asset manager, AIF, Sunil. So tell me, what are the concerns that you have heard from HNIs, when investing into an AIF? What really are the key questions that you have had to deal with? One is, of course, the taxation, the regulatory aspect of it. But seeing the enthusiasm and the interest and just the amount that AIFs have mobilized, there seems to be perhaps much clarity and understanding about AIFs. Do you think it's a much easy sell right now, AIF, compared to perhaps 3 or 4 years vis-a-vis earlier? Of course, that is how the products would have evolved. And what really are the concerns playing in the minds of investors even now? And I would sort of bring you in, Anjali, and then perhaps for the questions and the asks from the regulators to ease the process for AIFs in India going forward. Yeah.
I will have to step off at about 11:15. So I may not be able to stay for the questions. I just wanted to mention that too.
Okay, so Anjali, you want to sort of...
No, please. First Sunil and then I. And then I'll step off. Thank you.
So, so very clearly, taxation is an issue, but at least my perspective in life is that worry about something which is in your hand, something which is not in your hand, no use worrying. So, we'll just keep that out. So obviously, when we meet investors, one is this concept is still new and it's not as widespread. So, you have to explain to the investors the difference between a PMS and an AIF and a mutual fund. I think that is a major question mark. The second, I would say, is I would say it's not about the structure, it is more about the markets, whether to invest or not. So I would say that 9 out of 10 investors I meet don't ask me about what AIF and PMS and mutual fund is. It is predominantly about whether to invest now or not. I just wanted to make that clear. So I think the awareness has increased. Obviously, it still has to go to a wider section. I would say out of the 60,000 odd IFAs which are there, who take mutual funds to their clients, not even 1% have either the interest or the kind of investors, Andrew mentioned about 1 crore ticket size. They don't have that kind of investors who would be keen to invest in an AIF/PMS, and therefore the awareness to that extent is limited to maybe a handful of cities and a handful of very mature, private wealth guys like IIFL and the others.
Okay, Anjali, the solutions and asks from the regulator, so boosting the AIF industry further, what would those really be?
I think the regulator is fairly responsive at this point, and whatever enabling regulations the industry puts forward go through the due process, but are being given to industry. I do think it is important to keep that threshold on what defines a sophisticated investor. So I'll go back. It's actually, I completely agree with Sunil. I think solving for tax is, as a fund manager, the wrong thing to solve for. You should solve for returns. And if you have returns, then the happy part of paying taxes, you have income to pay tax on. Now, how much that tax is and all of that is a different matter. The second point is, for AIF investors, actually, as a fund manager, we talk about this all the time in the industry, you are better off taking a sophisticated investor who understands what they're getting into and don't think that this is something that can be redeemed like a mutual fund, because that then runs into issues later on. The third piece I want to say is, there are two different ways of thinking about this, which is, even in AIF, you have debt AIFs, which generate income more regularly and start creating returns right away. Whereas the equity AIFs, which is the private equity or venture type AIFs, category 1 and 2, and debt AIFs are separate. The equity AIFs take much longer. So your lock-in is longer. So it's very important that the industry understands this, the regulator understands this. Debt and equity are different. Debt AIFs actually are doing very well right now in India. And there's a lot of investor appetite for that also. And then publics are a completely different segment. So whether you set it up as a mutual fund, as a PMS, or an AIF, again, I fully agree with Sunil. I think the bigger question is, should I invest or not, versus what is the nature of the instrument?
I think that question, should I invest or not, will be a perpetual question always for markets. I think we had a very interesting discussion here. We spoke about mutual funds, vis-a-vis AIFs, the market for each other, the investor education, the kind of role a qualified investor brings to the table. If independent managers were to venture out now, what the risks and concerns they have to sort of be careful about, what really is there for the regulators. And I think there are two key aspects which I really want to dwell upon, and I think time is running out. And I think I would really like to have this August panel really sort of answer to that. This entire question of tech solutionism. For instance, right now what we are going through in the COVID scenario is that we see so many people reach out to startups on Twitter handles that suggest solutions on how to handle the COVID aftermath. If I were to put you on a situation where this reverse pitch, where suppose an Andrew or a Sunil were to pitch two ideas for AIFs in India from product innovation perspective, which they don't see right now, what would those really be? I see a lot of narrative building around the credit AIF, which I'm also seeing in the private equity space playing out in a big way. I know funds like True North getting into private credit space. So if you were to give me two examples, maybe one from you, Sunil, and one from you, Andrew, on the product innovation for AIF, which you don't see prevalent right now, what would those really be? Yeah. And Anjali, please stay back. I have a question for you too towards the end. Yeah, Andrew, I'll begin with you.
So I'll be very short. I think I adore IIFL asset management, and not because Manoj is here, but the kind of innovation they have been doing over the last 3-4 years is really commendable. The pre-IPO AIF was a phenomenal idea. They have a Cat 2 AIF which invests in a mix of unlisted and listed company. I think that's a great idea. I think if I were to launch something which is not in the pure listed space, it would be maybe a Cat 2 hybrid kind of an AIF, which will be a mix of investing in unlisted tech companies and listed tech companies. So I would say that at this point of time, it would make great sense. It would balance the risk, because you have 50% or more of your assets in an unlisted component, and almost as much in the listed component, which will give you the stability and also ensure that capital loss because of your investment in unlisted space will not be there. So I would say that would be at this point of time, the thought process.
Quickly, Andrew, when the unique to sort of add to what Sunil said.
Yeah, well, I think two things here. One, I just want to just very quickly just mention on this tax, because I listened to everyone else, but what it is, and I think the problem that category 3 AIS hedge funds in particular have seen degrowth, because when they increased the tax rate in 2019 to 42% derivatives, it's not then about performance, it does become about tax. You know, even if you make 15 to 20%, you know, after fees and everything, 50% has gone away. So that is, I think, is something that the government should look at, because if you invest today in our fund and your tax is less than 42%, the fund pays tax on your behalf. So you don't get the benefit of a setup. So that, to my mind, is not correct. But anyway, in terms of new funds, well, hopefully we'll be launching some of these. One thing that we probably won't be launching, or we might do in the future, is something not dissimilar to what Sunil was saying, is where you've got something which is kind of Cat 2 kind of investing in, not kind of venture capital, but more towards those companies which maybe are listing in 1 to 2 years' time. So you've got tied in liquidity there, alongside a kind of a hedge fund, which is giving you some kind of returns in the shorter term, whilst you're waiting for your longer term investments to come to fruition. That's the kind of fund. So little kind of private equity with public markets would be something I think would be certain investors would, I think, welcome something like that.
Anjali, you heard both your colleagues on product innovation. If you were to give an answer or a solution or a suggestion to them, what would that really be?
So as a personal investor in both public markets as well as structures and so on, I would welcome such a product which allowed you to do income generation immediately if that is desired, but also balance out your risk a little bit. But with my investor hat on, not as an individual, but as an investor hat on, I think it's really a matter of who is your target customer and what do they need. So if somebody has risk appetite, and we are seeing a proliferation now of micro VCs who are going even earlier, even riskier. So micro VCs, angel list, let's venture, it's becoming much easier to start pooling capital even outside an AIF structure to do the participation in this very, very early seed stage, idea level type companies, right? So I think there are those who have the appetite for that, and they will carve out some part of their savings or net worth or investable pool for that kind of asset class. And then there are others who will want to see more of a balance in a larger portfolio.
I think Manoj is back here. Manoj, you heard all your colleagues in product innovation. Do you have any suggestions to add on, one interesting product innovation that we can see from IFL, or sort of what you're perhaps thinking on?
Yeah, sorry.
You should talk about SPAC before you let all of us know.
Exactly.
If I may take your lead.
Anybody, I just came back. Yeah, I think, see, product innovation is, it all depends on the time and, what is available at, see, there are certain things that you bring well ahead of time, it doesn't work. You bring it after the story is over, it doesn't work. So you have to actually think in terms of, you have to be quick to turn around and bring something on the table. And I think that is where, though I have just taken over IFL Asset Management just about 2 months back, but I think that has been one of the reasons for the success, is that you decide something and then you quickly turn around and then make it happen. So I think I can discuss some 5-10 things. They're not just one, but I think it all is required at that particular time and whether it suits. In fact, we are recently now the kind of response what we are getting in terms of our Special Opportunity Fund 8, especially on the digital explosion that is happening. I mean, the kind of response what we are getting is tremendous, and the kind of investors what we are getting is not just the professional investors. It is, I would say that even people from the private equity fund managers are also investing. Okay. I mean, that's the kind of thing. So you have to just anything, whatever it is, you have to bring that one particular killer idea at that point of time and then turn around and quickly do that, and before the juice is out. So I think that's all I would say. I would not say anything specific, what is possible or what should be done?
Okay, I think Anjali had to sort of jump call, but I think she really mentioned a very interesting word, SPACs here. And I would sort of wanted to pick the brains on the SPACs investing in startups. Any sort of thought, Andrew, on that? We are seeing really a surge in the West. I mean, would you see that in India anytime soon, where SPACs could really become a mainstream conversation here also?
I mean, they could well do. I think actually, if you look at the performance of a lot of the SPACs now in the US, I think you'll find that they're actually losing money for people. See, it's very easy to come, and say we're going to go to the moon and back because you don't have any, regulations around that. It's not like an IPO, so you can just kind of, say we're going to, raise this money and then acquire something. It's fraught to my mind with danger. Because some of these people haven't managed businesses before and so forth and so on. So they're raising easy capital. They're getting great valuations for doing it. But if you look over the last 2 to 3 months, you'll find that most of these SPACs are now underperforming the market or have lost you money from when you originally invested. So it's a bit like sometimes, buying it into an IPO and taking the premium. But once you're listed, then you take your money off the table. I think that's maybe what's happening. So you could well see SPACs from overseas buying Indian companies. I'm not sure we're quite ready for a SPAC in India.
Okay,
I might be wrong.
Okay, my last question to you, Sunil, and I think it's an interesting sort of narrative that we are seeing, especially in the financial services space, about this entire concept of DeFi, which is essentially the decentralization of finance. When you talk about this, people, and especially millennials and younger investors, are perhaps losing confidence in a very trusted and very regulated way of managing money, right? I mean, they want something which is more peer-to-peer, which is more decentralized. And this entire question of, Bitcoin or cryptocurrency sort of has come in as sort of a very mainstream form of investment, especially in the West. I want to sort of get your view that how do you see these kind of narratives playing into innovative products like, AIFs, or where we are in the value chain of managing personal finances of people?
So first of all, a disclaimer, I have studied a lot on blockchain, but despite, I would say, spending a lot of man hours studying that, I have still not been able to understand the concept of cryptocurrency. So I am happy to not understand it and not invest. Coming to the millennials, I think obviously there are many of them, and obviously they collectively have the power of more than the biggest of biggest funds in terms of moving asset prices. But at this point of time, I have a 23-year-old son who's in San Jose, US. I don't think they understand what they are getting into in terms of valuations. I think it's a lot of hearsay, a lot of trending thing. One prominent investor comes and buys something, then you suddenly have 40-50% prices moving up, and then you have short squeezes and so on and so forth. So I would say that this millennials will learn, and they will learn the hard way. No amount of books can teach you, but some amount of losses can definitely teach you and have a more lasting memories rather than any books. In terms of changes, I'm sure that, as mankind, we will continuously evolve. So from horse cart, we came into cars, and from cars, we'll come to EVs, and maybe after EVs, there would be flying cars and so on and so forth. We will evolve. I think we are meeting virtually. Otherwise, most of our conferences have been in person. And it's a very convenient way of doing it. No one has to wear suits except Andrew, and we all can be in the comfort of our own homes. Things will evolve, and I think that is where understanding what the millennials are going to do is very important for any forward-looking investor. So I would say rather than just getting into something because it's a fashion, try and see how we can take advantage by learning from them.
Okay, so there's a big word of caution coming in that fashion can soon become fad. And I think perhaps the millennials would learn more from their losses, and no books can teach them. Quick rapid fire. Andrew, what are you Netflixing these days?
I watched Rocket Man last night. because I'm a big Elton John fan. So I saw him in Las Vegas once. He did the Red Piano. So I saw it had just come there. So I just thought I'd go and watch it.
Okay. Sunil, your one advice to your colleague, to your asset managers and mutual fund industry.
Keep positive on India. There's a lot of money to be made.
Okay. Manoj, 5 years from now, if people were to look at this coronavirus pandemic, how will they remember this?
I don't think anybody will remember this. It is just a passing phase. We don't even remember what we did last year, same time. And it's just that as long as economy does well, people are growing, incomes are growing, and like what Sunil said, he's positive on India. And next, he said 5 years, I'm positive for the next 10 years. I don't think anybody will remember what happened today. And they will just say that, okay, it was just a passing phase, and then we are back to normal. So I think that is what will happen 5 years down the line.
Okay, thank you, gentlemen. I think we have so much to cover, and I think it's a very interesting conversation here, a very wide-ranging one, and we could cover as much as we wanted. I think the time was short, and we could not have Anchi, and I think Sunil also has to jump out. So Aditya, any questions from the audiences before we sort of sign off? Because I already see the panelists for your next session waiting in the queue. You're not audible, Aditya. I think you're on mute.
Yeah, am I audible?
Yeah.
Yeah, you're audible.
I'm so sorry. I'm so some issue with this Bluetooth. So we would have loved to ask audience for the questions, but unfortunately we're already out of the time for this particular session. I think the next session starts at 11:30. I'm sorry. So
Okay.
this guys are waiting. So at the expense of my next co-panelist, I'll just quickly ask the audience if there are any questions. Maybe we can push our luck and because a panel like this we don't get to meet every day. So guys, if you have
maybe we can take one question,
Yeah,
one or two questions for the audiences, I think.
Yeah. So okay, the first question. Any significant opportunities you're seeing out of the GIFT city for AIFs? Anyone can answer.
Who will take a stab at that? Maybe so Andrew, the GIFT for AIFs opportunities.
Yeah, as I said, at the very beginning, that GIFT City, affords us an opportunity to have a reputable jurisdiction which will compete with the rest of the world at very much a lower cost, and we can all manage the funds, sat in India rather than having to have an offshore presence, which you don't really need. So because on being on the ground, I think gives you much better advantage than people be set offshore as well. So I think this will evolve, and I think it's a very big opportunity. And if we can do it, I'm not just talking about hedge funds, or if we do it across the board from venture capital through to private equity, and put ourselves on the map and put GIFT City on the map, then I think the opportunity is very significant for foreign funds flows to India to become more directed away from, I'm just talking about equity for the moment, but away from some of those kind of emerging market funds to India focused funds as well, which I think has been lacking for some time.